Hi, this is Randy Finney with the Right Side of the Chart, and this is a morning market update for Thursday, October 25th, 2018. A lot of movement in the markets lately, so I'll keep these updates frequent as long as there's some developments worth noting. Let's start out with the futures. There was a little lift in the futures last night. Um, Really, at this point, nothing to be concerned with. I mean, it's a sizable lift. Right now, if you look down here in the bottom left-hand corner, these are the NQ futures. They're up about 0.89, about 9/10%. Was up. They were up quite a bit more earlier, but that's really nothing, relatively speaking. That's, a 2%, normally almost a 2% rise in the futures would be a big move. But compared to what we did yesterday and compared to the recent volatility, this is just run-of-the-mill stuff. You just have to expect that, live with that. Doesn't mean it can't morph into more, but you're not going to have the markets drop almost, or QQQ drop almost 5% and then sit flat for the day. So that's where we're at now, and let's just look at levels and see where this thing can go, and I'll tell you some of the important developments I'm noting. Here's a little reaction low. We overshot it a little bit. SPY reversed, or ES, the ES reversed right at that same reaction low, the comparable reaction low. But here's the big levels still, and these were levels the other day. We have these downtrend lines on the 60-minute chart. I have a parallel downtrend lines here. There's been some volatile trading, some choppiness through there. And then this level here, horizontal price resistance. That's one level that I would really like to see the NQ remain under to keep the bearish case alive. Now, very important. This is why I'm doing this video. The markets are very stretched. I talk about that rubber band analogy. The more you stretch a rubber band, the more it's going to snap back. And the more you stretch it, assuming it's one that can't break, you get to a point where it's harder and harder to stretch. So we're quite oversold right now on the daily time, all just about all time frames, especially after yesterday's move, short term, long term. But here's what I'm concerned about. There's some cross currents here. I've mentioned in the past. I love to see for swing trading when there's a big correction or a trend or a rally for that matter. I like to see divergent highs and divergent lows on the 60-minute time frame. Even better, we can get them on the daily, but on the 60-minute time frame for swing trades, just like this was a divergent high here. There was on, when you look all the way back here, this trend line went back a ways. We broke from that little wedge after the main trend line break, and boom, that triggered the sell-off that we're in now. So this is a big divergent low, something worth noting. The divergences overnight were confirmed, but remember, we had divergences on just about all the other indexes besides the Nasdaq 100 yesterday. But I wanted to point this out because this could morph into something more. So we're at that, I think, an important point. I'm running off a lot of, I'm running off technicals primarily, but I also talked about my my theory where the market is, and if we don't recover soon, if it can't snap back soon, we have some big earnings today. They're probably going to hold it up, I'd imagine, before those earnings today, but who knows? My concern is that the big institutions, especially pension funds, those that are on the hook that are supposed to run a balanced portfolio without excessive risk, since they're not seeing the big gains in treasuries that they normally rely on when the stock market corrects, I'm thinking they may have to continue to unwind their long positions, as well as margin calls being hit. And I can just tell you, the more we go down, the further we drop, the more it should exacerbate margin selling, rebalancing amongst funds that have a balanced mix. And otherwise, if we can rally off here, we're quite stretched, and these divergences could play out. So I want to say it's not my preferred scenario. I'm going to extend these lines, but I certainly have to be on guard for it because the snapback rally, if we get one, if these start to play out, would be impulsive. So what I think will probably happen is maybe a push all the way back up to that trend line if we get that 70, what is it, 70.57 level again, and then another thrust down in the wedge to hit at least my first target on the QQQ short and some of the other trades like the semis. I'm on alert. I'm watching things closely. I may close out some of the short trades at their earlier targets, for example, SOXS and SOX. It's not far from the targets. I'll get to that in a second. And again, it depends on what I see. But if we can get, especially if earnings don't go well tonight, we're really not going to probably have a good idea until tomorrow, Friday's trading, because once all the today, this is probably the single biggest earnings day throughout this whole season. I know Apple's coming up. Apple's a bigger component than what's reporting tonight, but not collectively. Collectively, we have Amazon, Alphabet, and Intel. So Intel's, big leader of the chip sector. Intel's actually at pretty decent support. I'm going to get to that in a second. And let's just move on to the ES futures here. Okay, this is ES. These are the S&P 500 E-mini futures. Trying to plot where the markets are going. The large cap indexes make up the vast bulk of the stock market. You can add up all the small cap stocks in the Russell 2000, all the mid caps, and it pales to what the market capitalization is in the large cap. So that's where my primary focus lies. And there you can see the levels. Here's that reaction low from yesterday I talked about. That's exactly where ES reversed. So far, it's below that. And you know, with these divergences in place, we could certainly, like I said, that's let's just say as of now, and believe me, the markets are very dynamic right now, meaning constantly changing, and therefore my analysis has to also be dynamic and adaptive. But as of now, it'd be almost nice to see a little thrust up there, even a brief pop above that line. It could happen today, it could happen tomorrow. May not happen, but if we did work our way down within this wedge, I should have given a little bit of room here to the chart here. Maybe I can do that now if I drag that over there. Yeah, there we go. All right, so there's a scenario. This downtrend line, these divergences could pop now, but they could also easily play out for a little more downside, extend the divergences, something along these lines here, keep the divergences intact, and work our way down within this wedge and then set up a nice long entry here once some of the additional downside targets on the daily charts are hit, and maybe reverse, close our shorts, and go long for a bounce. Sooner or later, we're going to have an oversold bounce, but if you step in a little too early, like I said, we're at I wish I could tell you with a high degree of confidence, are we going to go down another 5% or so, or are we going to snap back before then? And, these divergences say we could snap back, but where we are right now with this impulsive selling, obviously margin calls have been hit lately. The trend is down, so we don't have any evidence of a bottom. That's the easiest way for me to say this. So you have to respect the current trend, which is down right now. So that keeps us on a short the rips and cover the dips, or hold on if you're a swing trader again until we have some decent evidence of a reversal. Just to lay out that number, there's that big, the where I'd really like to see any bounce contained. And again, more so on a daily. If they pop above it briefly and fall back down, that's one thing. But 2750, or we'll call it 2751, give or take on ES. And then of course there are some resistance levels above that, and quite a bit. Like I said, the market has a lot of work to do to the upside, any rallies. And when you get this oversold and volatility is this high, you're going to have sharp swings in both directions. So just prepare for that and budget that into your stops, your position size, and everything else, whether you're trading long or short. Okay, the markets haven't opened yet, but I just showed you the futures are up. Again, nothing big relatively speaking. Here's QQQ yesterday down 4.58, so a zero point 0.9 lift, a 0.9% lift in the futures. Is not even, it's not even a, I don't even, that shouldn't even be a 38% retracement, which is typically a minimum fib retracement. It's a minor retracement so far, but here's those potential divergences. Again, I don't want to spend a lot of time on this because I covered it yesterday. Momentum indicators are still pointing lower, although we're going to have a gap up today, and we'll watch. That may confirm the divergence here. In other words, give us a bullish crossover on the PPO, reverse on the MACD, and again, that sets the stage for a rally. And when we go back to QQQ, remember we have this 15-minute downtrend line. You can come off the highs here back in early October, or you can start it right here. It's the same trend line if you want to start it on that October 17th reaction high, and watch that trend line. And the same levels that I was pointing out yesterday that contain this bounce, should ideally contain any bounce today and or tomorrow post earnings. But like I said, there's just a lot of overhead resistance, and just if we take that trend line out, that could spark a much larger rally, or we could stop and reverse at any of these resistance levels. I just right now it's too hard to say, but I am on guard right now with these 60-minute divergences. There it is on SPY, the S&P 500. Any bounce in SPY ideally should be contained here around the 279.50-ish level. QQQ, I mean, if we really get a bounce again, 178. That's a big level that I've been eyeing as a level that this if we are going lower, that should contain a bounce. But remember, if we bounce all the way to 178, that's a big bounce. That's about almost 8%. But again, let's put it in perspective. Here, let me show you this. What would that mean? Let's just take some Fibonacci retracements from here. See, it would only be, it would keep us under the 61.8 Fibonacci retracement. For those of you not familiar with these, typical counter trend bounces, meaning a bounce within a larger correction or uptrend. A counter trend bounce will typically run up anywhere from the 38.2% to up to the 61% Fibonacci retracement, which is this area here. And again, that's a big bounce if you're short and you're going to ride that out. And then there's no guarantees if you ride that out, if that's going to end the bounce or if it's just the beginning of a bigger move up. So, you all have to use stops depending on your position size, where you entered, your average cost, what your targets are, if you're short and if you're long. Or trying to game a bounce. There's just a lot of variables go to this, but I can give you the levels that I'm looking at, and that is certainly one. Um, I wouldn't expect anything close to that before these big stocks report tonight. But depending on how those earnings go and what we see into tomorrow, those are levels to watch for. Now let's look at the downside levels. Jump out to the daily chart. Okay, so here we are on a daily chart, like a couple boards here, and let's go to this one here. These are our official trades right now for the QQQ short trade. There's our long-term trend line, comes off the mid-2015 lows, and so far, the technicals say, uh, you know, sharp move down, kickback rally, flag action that came in and back tested that multi-year trend line, a rejection at the trend line, and the flag would indicate more downside to at least my first target. And this is where I'm starting to lean towards covering all short positions, at least the QQQ short, if and when that's hit. So I'm going to give you that heads up now. Now, one option is if we get a meltdown move here, stops start getting hit, especially if things don't go well tonight with the earnings reports, what you can do is trail stop down. Now, you're not going to trail stop down with 5 cents on a $160, $161 share price on QQQ or SQQQ, whatever you're trading. You're going to need to give it a little bit of room or you will get stopped out in the grind. But that's always a strategy I like to do. When you have a trade that has potential to run, but you think, okay, this may be the final target before we get a meaningful bounce, then when that target is hit, instead of booking full profits, just set a stop somewhere above, a few points at least, maybe 2 percentage points. If you milked a bulk of this move down so far from where we had all those sell signals, you're up, 11% or 3 times out on SQQQ, or a hell of a lot more on NQ if you're trading futures. And you can afford to give back a couple percent to possibly milk out that target. There's another, if my final target's hit, then we're looking at another 6.5% or so downside from where we closed yesterday. You add on another percent for the gap. Well, who knows? I'm doing this video. It's 9:13 now as I talk. Markets will be open in 15 minutes. Anything can happen. That's one thing we've learned. If you're new to the site or new to trading, don't get yourself worked up with what the futures do overnight. If there's anything that they've taught us, if you watch the futures over the last couple of weeks, just like yesterday, we're down big, at night, we're down almost 2% overnight, and then boom, the market opened up and reversed that and rallied back up. We've seen that quite a bit. So it's almost as if you can reverse the trade on the futures. If the futures are up strong like they were today, they're starting to drift back down lower. There's a lot of mean reversions, but I'm not telling you to do that. You don't short the futures just because they're up 2%, and you don't buy them just because they're down 2. All I'm trying to say is that the overnight session is a little wild. Some of the swings at 9:30 a.m. the big boys come in, the institutions come in. There's more liquidity in the market. That's when you're going to see some moves and often a reversal, whatever the futures have done. So that's it. Right now, the charts to me indicate more downside, and Unfortunately, I wish we didn't have the big earnings reports today because that could swing things other way, and it could also work in our favor being short, very much so. So we'll just have to see what happens. SPY, many boards here on SPY, but same story. And what I want to highlight here are the support levels. So SPY has given up this 268-ish level and really doesn't have a lot of support down here to 258.83 or so. And then you can see a support zone. It could snap back. That's a possibility. It may have been a momentum fueled overshoot yesterday, but as of now, you have to treat these levels I'm showing you here on the daily chart as resistance as well. I gave you 60-minute chart resistance, and these are levels, that 169, 60-ish level on QQQ, the 200-day moving average. Those are all levels that you could add to on a short with a stop somewhat above if we get a kickback rally. And we may not get it because remember, this is the most important thing I can say in this video. Right now, I'm talking about all the possibilities of a snapback rally, but right now the technicals are clearly bearish. If we may or may not get a reversal, but you have to trade sometimes what you see. And this is we have the Qs well under their 200-day moving average after testing it several times, which is also the key 40-week moving average. Um, and sure, the earnings tonight have the potential to put us back up above there again. But from my experience, usually when you give it up this much, you're not going to take it back. That's just normally. So there it is. So right now, and it certainly was support, so that would act as resistance. So there's your potential bounce back targets. You just got to be careful. You're much better off if you already have some shorts and you're adding to positions because you're profitable on the current ones. But if you take new positions, which you can do if you're nimble, again, stops just somewhere above resistance. You got to give it a little room. Can't run a 0.5% stop in a market with this kind of volatility. You're just going to have it clipped in the noise and the back and forth grind. And there's the targets, down here. I can easily see, and going back to QQQ, I set my final target right now in this trade here at just above 154. The actual support level is 153.90. Like I said, one of two things will probably happen if we hit those targets. We'll either reverse just shy of those lows, or we'll undercut those and then reverse. So that's that. Those are levels to watch. A couple more indexes to cover, and then we'll wrap this video up. IWM. IWM is at a pretty decent support here. You can see these lines. I've had these lines on my chart for quite some time, and what I'm referring to here, it's right about here. I have two lines in close proximity. That's a support zone, and pretty significant. There it is. It's really, we closed just a hair above it today. You can see there's a little more downside there to that support zone. And the next support, if we continue to waterfall sell off, if we have a meltdown in the market, a lot of unwinding of the margin trade, next support, decent supports down here about 135. I do have some support around 140. I should mention that too. That line wasn't very straight, but let me turn these lines on right now, color-wise, since they're starting to come into play. You can notice that some of the lines on my chart I try to dim out when they're not really nearby levels, but now, so there's some potential targets there. Again, but we're getting very stretched. You don't want to short right here, right above support if you're not already short. But bounce back rally maybe, or you can continue to hold on, and that's where the big money is made. It's not easy to do, but you let your winners run. Cut your losers short, use your stops and let your winners ride. And right now, although we're at support and very oversold, like I said, oversold can and often does become quite more oversold. So there's IWM and mid caps. I wanted to touch on that. This is funny. You can see back here, back on what was this, September 20th. No, that's not the chart I wanted to. This is it, September 27th. Yeah, I had the bearish rising wedge. I started highlighting on September 20th. And on September 27th, I posted this chart here, covered it in a video as well. Support one, I showed the mid caps breaking down. That's our first support level. That was your first sell signal, was a break of this wedge, and then that S1 level support. Then I had my first target here, second target here, and then what I called if things get ugly, first target, if things get ugly, second target. and if things get very ugly, target zone. Now let's look at where we're at now. Again, that was September 27th, and here we are today. So you can see, and this is just a beautiful example of technical analysis that was, posted well in advance. Waterfall sell-off kissed my first target. You can see there to the almost to the button. It bounced from there, got a nice reaction. That's when we got long and bullish, for a bounce a couple weeks ago, for them to have a counter trend rally, park it on the major averages, the large caps on their main support levels, which they did. That bounce ran its course, bear flag, broke down. So you can see now, I'm going over this for a couple reasons. Now we're below, this is a pretty significant support level, and we're below it. We shot below it yesterday. So if we can't snap back, there's still the possibility that was a momentum fueled overshoot, meaning we had such velocity going down in there that maybe we overshoot it, we come back above it and hold that level or rally from there. So we got to watch this today. This will be important. Again, tomorrow everything can change after the big stocks report tonight. But as you can see, if things don't go good, the market needs to really, I guess what I'm trying to say, the market really needs to reverse here. There's a lot of things I have at key support levels or just below them. So there's still a shot for the market to reverse, for those 60-minute divergences to play out, and then to have a decent rally. And we could come all the way back up here to this former T2 level in the mid caps easily, or more. But if not, if it can't, I think just the dam will break. I think we'll just waterfall sell down to this things get very ugly target, and that would be a move of roughly, another 6.5%. Kind of aligns with what I just showed you on QQQ. My max downside from here. All right, so I'm going to do through here. We're done. I'm going to wrap up. There's 11 sectors in the S&P 500. Let's run through there because this is what goes into my analysis. I don't just look at the indexes. I look at each and every sector, run through here, and it tells us a lot what they're doing to what the market's doing. So like I said, I'm waiting to see a flight to safety in bonds. I think we'll get it. I feel very confident if the market continues much lower, if we get that waterfall sell-off, you'll start to see money come into treasuries for the two reasons I mentioned. If you're new to the site, and I alluded to this in the trade yesterday when I posted TLT, there's a technical reason, the case that I've laid out before, and the fundamental reason, which says I think there's going to be a negative feedback loop going forward for the next year in the stock market, whereas anytime the Fed continues to raise rates from where they are, if rates go higher, you're going to see the market correct. It will not take that. And we already saw it throw a temper tantrum this time around when rates peaked recently. And then the market corrects. And then what will happen is there's a wealth effect. Consumer spending accounts for about 2/3 of GDP. And consumer confidence it's a coincident indicator. Don't let anybody tell you it's a leading indicator. It's a coincident indicator with the stock market, meaning the stock market goes up, consumer confidence goes up. Stock market goes down, consumer confidence drops. So you have a correction like this. If it gets worse, even with this, you're going to see consumer confidence drop off. And when consumer confidence drops off, then the economic outlook for going forward for the economy goes down. Therefore, long-term rates go down. So Treasury bonds should rally. If I said that too fast, just remember, interest rates drop, bonds go up. There's an inverse relationship there. So that's what we're playing at here. So again, I have a technical case made and a fundamental case. And even if treasuries slide around sideways for a while, we're getting paid to wait. That's the nice thing about treasury bonds. So utilities are a flight to safety instrument. So here we had a divergent high, rising wedge, correction, and now we're back to resistance. I just want to point that out. So this is where institutions have been flocking lately. Utilities are considered defensive issues, safe haven assets. And so we had a rally, pretty good rally, but we're at resistance now. So we'll probably stall there. And that came after divergent high. Any additional high from here will simply be an extension of this divergent high. So my expectation is that any upside in the utilities from here is minimal. Maybe another pop above that level, maybe challenge these highs, but then we go down and we go down considerably. Here's an uptrend line you can watch. Wait for a short on utilities. I'm not adding that in this official short right now. There's just not a lot of meat on the bone for utilities. Plus, they pay dividends. I don't care to short high dividend stocks. XLRE REITs breakdown. We were short this one for the bulk of that move down via SRS, the 2 times short REIT ETF. Hit support, back testing right now. So this one's probably going to reverse here soon. I'll have to confirm that with the charts IYR. So you may want to hold off. If you're interested and you're a gold member, drop me a line in the trading room and I'll give you a chart and my thoughts on the REITs. XLP, another defensive. So far we went through the first three were defensive issues. REITs pretty much. And there's different types of REITs, utilities and consumer staples. These are all defensive issues, meaning they tend to do well during a recession or an economic downturn. Consumer staples are Colgate, Palmolive toothpaste, and things that you buy and you need, and no matter how bad the economy gets, you continue to buy those things. So those then they tend to do well or hold up relatively well during an economic downturn. And you can see the institutions have been flocking to those stocks recently, getting out of tech. XLP, that was XLF financials, still big red flag to me. Financials are just bleeding off. There is some support here. They are at support, at or near support. And if they continue lower, this purple line is really where I'd be interested, and that's about $24 on XLF. Might be interested to step in there. They could bounce before then, but I don't have any interest right now. XLY, consumer discretionary. As the name implies, when you have discretionary income, more money than you need, that's discretionary income. You buy things that you want, not that you don't need. Consumer staples are things that you need. Consumer discretionary are things that you want. Big screen TVs, you name it. And Amazon's in here too. There's a big breakdown, impulsive selling, very long-term trend line that goes back for years, even to the left of this chart. That is a clear sell signal. At best, this one snaps back to 107.45, and that's an objective short entry. But otherwise, I think we come on down here to this first target level, about 99.84. So before any type of reaction. And if things get ugly, here's where we're coming, 92.37. Staples, discretionary, basic materials, fallen off a cliff. What does it tell us about the economy? Overshot support here, has some other support. Again, this one has, like a lot of these, the ability to stick save and come in at the end of the week and park back above these support levels that have just been overshot. Basic materials doesn't have much of an impact on the S&P 500, so it's not going to really affect where it goes. Healthcare, at support now, reaction high here, and you can see some different support levels. But these are ugly looking charts. They're not, we're not going to go down forever. XLI, industrials, almost 10% weighting. This is a pretty significant support we're at. So, these are the things that have to give you a little bit of pause on the short side, because the market is either at, or many sectors, either at or very near key support levels, close enough that they could certainly snap back and close the week back above that level. What else is there? Energy's just fallen off a cliff. I made the case for a top, significant top in oil recently, and that's played out. So energy stocks are going right down with oil, but there's some nice support right here for XLE. In fact, if it takes that level out, you have support down here, but these stocks are starting to look interesting for a bounce soon. I'd have to look at the intraday charts, so I'm not right now stepping in, but maybe soon I'll check the intraday charts. Tech broke, like I said, breakdown, back test, and now below that $68 support. Next stop down here, 65.30, unless it can snap back above there. And this would be my final target. If we get down here, this is where I'd be very interested in closing all shorts, tech related, and starting to reverse to go long for a bounce. And the levels down around 61, 62 and change, somewhere in there. And just one more, since this is an important subsector of tech. Here's SOXX. We have an active short trade on this, and or SOXS, the 3 times short. Big impulsive candle. I mean, we got in right around the right time when it broke down here, and there's that impulsive selling. Again, targets down here. I'll give you the targets. There it is on SOXX. We're very close to that first target. So if you want to take quick profits, if you went short yesterday, or you were short up in here, we a good chance we'll get a reaction off this level, about 152 and change. If not, if you want to trail down stops and go for the big kill, down here about 138.90. And again, I have the SOXS, because of the decay. These are rough targets. I would say this: if you're in this one, and I'm doing this because, look, here's an example. I told you guys you can do better. Everybody talks about the decay, and leverage ETFs are awful holds. 19% yesterday. Oh, the market just opened, so I'm not going to get a C. Oh, there it is. Okay, we haven't updated yet. 6.56. You can see the outperformance on those leverage ETFs. All right, we're going to end it here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.